Hi subscribers and welcome back to the channel. Today we're joined by Jonathan Laws again in London to have a conversation about client portfolios being overcomplicated. John, how are you? How are things going?
Yeah, very good. Nice and busy, but good busy. So yeah, no, I'm glad to be back on the channel. Diversifying, pun intended, the channel with a few new fresh faces.
Very good. So John, when it comes to portfolios being overcomplicated, I think the best place for us to start is with diversification. So can you give us an introduction as to what diversification is and why it's so valuable to investors?
Yeah, so basically, diversification is the idea of the different things you have, the more different things you have, the less risk you have to one particular stock or one particular area. So the idea is if I have loads of different things, if one part of the market goes wrong, that's okay, because whilst that might go wrong, other parts of my portfolio, what I own, might do well in reverse. And the idea is that it should kind of counter each other slightly. So instead of the market being down 25% and me being down 25%, I might only be down 10%, 15%, and that's because other areas away from that part have actually helped shield some of those losses. So that's the idea of diversification. It has its limits, and that's obviously what we'll probably go into and discuss today. Sometimes you can be, quote, over-diversified, and there are limitations, but yeah, that's the kind of one of the key ways to summarize it.
Okay, and how is diversification achieved within inside an investment portfolio? So for example, a SIP pension.
Yeah, so the way to achieve diversification is effectively to own more things. Now, that doesn't necessarily mean you own loads and loads of different funds. It just means that you own loads and loads of different, bonds or stocks within those funds. So, that's how you need to achieve it. Own loads of companies, own loads of bonds, perhaps you own a few other bits and pieces, but that's how diversification, you buy and buy and buy. The more you buy of different things, the more diversified you are.
So, why is it you think when you view client portfolios that a lot of them are overcomplicated?
Yeah, I think it comes down to, sometimes clients can get a bit confused by, the difference between actually being diversified, which is owning, loads of different stocks all around the world in different countries, and some are big companies, some are small companies, and actually owning loads of individual investments themselves. If you own one fund and it owns 10,000 companies, that is more diversified than owning 10 funds that each hold 50 companies. So what you see is people kind of hone in on the amount of funds they have, and that's why clients will come to us, and whether they're advised or non-advised, and sometimes they'll have 25, 30, 40 different funds, and then we'll compare it to our portfolios, which can have 4, 5, 6 different funds, and actually our portfolios, despite having hardly any funds in comparison, are much more diversified, because those 4 or 5 funds own a lot more things than those 10, 20 funds do.
And can you tell us any examples of client portfolios that you've been through where you've just like, this is very overcomplicated?
Yeah, I think there'll be a lot of times where, and this is where, you can always tell when someone's an actual proper financial advisor, proper financial planner, and someone's just kind of, having a play around with your portfolio and trying to sell their services that way. I kind of call it, and I've seen other commentators call it, the illusion of complexity, where, if I get my client 50 different funds and I chop and change them every 3 or 4 months, that will look like I'm adding value. Now, in reality, when you look into it, a lot of those funds all do the same thing. They all own the same thing. So they might come across as really diversified, but actually they're not. Because if you own loads of funds that all own the same things, you're not actually very well diversified. Plus, you're making life very complicated for yourself. It's very hassly. There's probably a lot more costs involved than you realise. And the Cameron James philosophy and all the evidence support is to keep it simple. Philosophy, and that's what we hold, and that's what we see a lot with other clients. And on kind of take it the other way around, sometimes you actually see clients who are not diversified enough, Now that will usually be, when you usually see that is when someone is individually buying stocks. Now, we kind of have this view, I certainly have this view, that individual stock buying is probably a very, very bad idea. If you know the vast majority of active fund managers, the vast majority of hedge fund managers, all the most famous people in the world are absolutely rubbish at picking stocks. What makes you think you're going to be any better when you can't put all the time and effort and all the qualifications and education into it that they can? So what happens is you put loads and loads of money into a stock, and you know what? You might do well. You might have the greatest retirement ever. Just all the evidence says you're probably not going to pick those one or two stocks that will do that, and you'll probably end up shooting yourselves in the foot. So by all means, if you want to play around 5%, 10% of your money in one of your taxable accounts and play around with the stock market, I get it, it's interesting. Just don't go investing your pension that way. And it goes the same way, with the complexity. You want to be diversified, but not too diversified, because actually, there's only up to a point where diversification is very hard to create any higher.
And an interesting point you said there about cost. So why do you make the connection between overcomplicated portfolios and cost?
Well, as I kind of alluded to, a lot of times, especially if it's coming from another financial advisor who's doing this, invariably all you're doing is adding more and more funds. Sometimes it's harder to keep a track of those funds. They might have higher fees. There's going to be transaction charges as well, because instead of buying 4, 5, 6 funds or rebalancing each year or making a few changes every so often, you've now got to do it with 25 funds or 50 funds, or I've even seen some of 100 plus funds, which is completely nonsensical. So all you're doing is adding in different areas that could go wrong. You're adding in areas which is harder to keep track of. You're overcomplicating things, and that can invariably lead to higher fees, and it stops you concentrating on what really matters, which is concentrating on things that you can control, which is all the proper financial planning stuff and not the investment markets.
Interesting. And when you say that, that's something which most listeners have probably find or listen. I think that sounds a bit scary. That we and they cannot control investment markets. Why do you say that in terms, or just go further on the things that clients can control and the things that you believe clients can't control?
Yeah, so we're all in control of our own lives. Obviously, there are some things out there, whether it's inflation or conflicts or whatnot going on, that we obviously don't have too much input in. But in terms of those things of how much are we earning, what income streams do we have, how much are we spending, when do we want to retire, how much are we going to spend when we retire, are we going to do up the house, are we going to sell the house, are we going to start renting, all these different things. They're those things you actually control. The stock markets you don't control. The idea that you are going to always be able to pick the best funds or pick the best active funds and be able to control that, or time the markets and know when to buy and know when to sell and whatnot, it's just very hard. None of the evidence supports you doing it. I've never seen anyone ever be successful at doing it, apart from 3 or 4 hedge fund managers who are infamous and famous and multi-billionaires for that very reason. The average investor and even the average person qualified to the hilt, like myself and other advisors at Cameron James, also aren't any good at it. So concentrate on the things you can control. Leave the investments to themselves. Only make changes as and when you have to, whether that's rebalancing or a cheaper version of that fund comes out or whatever. As long as you keep it globally diversified, own the world. So that's another thing. I think you sometimes see clients have it's called a home bias, where we live in the UK, we see all stuff about the FTSE 100 and all the different companies, and we see them on the high street, and invariably you come across a client who lives in the UK and lots and lots and lots of their portfolio is invested into the UK stock market. Now, regardless of what you think about the UK stock market, what's going to happen, fundamentally it's less than 4% of the world's global stock market. So if you've got your portfolio and you look at it and it's more than 4% invested into the UK, you are over concentrating into the UK market. So that's another thing where diversification falls flat, because you can own loads of stocks, but if you've got loads of it invested in the UK, well then actually you're not very well diversified, and that's why trying to move away and have a global outlook on it is the way to go. Hedging your bets around the world as opposed to putting it all on red, or in this case, the UK.
So let's take an example. Say I came to you as a client. I was looking to transfer my SIP to you. I sent you my SIP valuation and I was holding 40 different funds and 30 individual stocks. First of all, without retching, what would you do to remedy that? What type of advice process would you take the client through? And also, how would you, this is a tricky question for you, how would you help educate them that, like, without necessarily being rude, but how would you help educate them that, like, what you're doing now is harming yourself most likely? So yeah, a couple of triage questions there for you.
Yeah, so I think first you've got to brace them to let them know, right, we're going to look at your portfolio. I'm going to plug it into our software that's going to review everything. It's going to look at the past performance. It's going to look at your risk you've been taking. It's going to look at the fees you're going to pay. And I'm going to promise you the very high likelihood that you are going to probably get a lump in the back of your throat when you realize how much money you've left on the table. So that's the first thing to let know, because hand on my heart, I've never, ever, and I swear on my mother's grave, come across a client who's ever had individual stocks, all this complication in their portfolio, and not had a much smaller pension pot than they should have if they'd have just kept it simple. Never seen it. Whether that's people with loads of different things or just one or two different things, I've never seen it. So I think that's the first point, to let you know this might be quite an illuminating but also excruciating experience sometimes when you actually see just how poorly things have happened. And I know how it is. Sometimes you bury your head in the sand to kind of pretend all those losses or lack of gains didn't happen, but unfortunately they did. So that's the first thing. Then the other thing is to kind of compare it to our portfolios, which are between 5 and 6 funds these days, depending on your level of risk. And to actually show them, like, look, we've got 5 funds here, you have 500 funds here. This is a much more diversified portfolio than this, because you've just bought individual stocks, they're all in the UK, or you bought all individual funds, they're all in the UK, or they all invest in the same thing. And actually these 5 funds that own, 100,000 different investments when you add up all the bonds and stocks, is actually much more diversified than this, even though when we print out the valuation, it's 12 pages of A4 to actually read it all. So that's that one. In terms of the education thing, it's tough because, and this is where being a proper financial planner and focusing on the cash flow and focusing on the things you control is so important, because if you're only talking about the investments, then it's very hard to try and tell someone, oh, what are you going to do when the market falls 20%? Nothing. What are you going to do when the market rises 20%? Nothing. Oh, Israel and Gaza is going on now. What are you going to do about it? Nothing. But in reality, that is the best value ever, because usually doing nothing is the best thing you can do. There's one thing readers can always have a good read of. I don't know if they're nerds or too interested in this, but JP Morgan releases a quarterly guide to the markets, funny enough, every quarter. And one of the most interesting graphs in that, or charts in that, is all the different average returns over the last 70, 80 years experience. You'll have property, and there'll be international stocks and US stocks and bonds and all the rest of it. And right on the far right hand side, right near the bottom, is the average investor. So even though your famous 60-40 portfolio has done 7% a year for the last century, and stocks have done 10% a year for the last century, the average investor's done 2.5%. Why has the average investor only done 2.5%? Probably because they've been scared. They haven't invested anywhere near as much as they should. They've been buying and selling. So even though the market might have returned 10%, and even if they owned bonds their entire life, they won't get those 10% returns, because they're going to give in to their emotions, like we all do, and buy and sell when they shouldn't, panic when they shouldn't, get scared when they shouldn't, and they won't actually obtain those returns. And that's where a financial advisor can be, because focus on what matters, keep you on track, and that's where the value is.
Yeah, I mean, that's staggering. 2.5% average return in comparison to what the market has done. And so to that end, like, a lot of clients, I would say, struggle with, well, not all clients, a lot of people understand some clients struggle with the idea of paying for financial advice. So for example, if you have a financial advisor, like here at Cameron James, we're 1% per annum. If you have a financial advisor for 10 years, that's effectively, some clients see it as 10% lost growth, or 10% out of their pot, which could have stayed there if they'd self-invested it themselves. So do you think this problem of cost aversion is clients just being clients, or do you think it's coming from a client's lack of trust in the industry, or a lack of knowledge of knowing these statistics, such as the average client return being 2.5% versus, say, a 10% equity portfolio over time?
I think it's probably a combination of all three. I think on the one hand, I think you do sometimes have people that don't actually appreciate how emotional investing is, and will try and do it themselves, and as I've said, I've never actually seen them actually have any decent performance, but will like that. I also think it's a bit of a searing indictment on the investment industry, and the financial advice industry as well. Okay. And obviously, there are a lot of financial advisors out there who aren't proper financial planners. In fact, I'd say it's probably the majority, if not the vast majority, even in the UK, but especially offshore, who are all about investments, selling you on investments and how great they are, which, as the statistics say, is naive at best, downright delusional at worst. And, they have bad performance and rubbish returns because they're trying to beat the market, and there's high fees there. So you've had a lot of clients scarred. You've got a lot of clients or prospective clients whose mate's been scarred, and even from the the big famous fund houses in the UK. I won't mention them. I wouldn't look at their share price anytime soon. And then you look at some of their fund performance. It's dreadful, and they're the biggest and most famous FTSE 100 company going, who shan't be named. So you've got a combination of that, and you've also got a combination of not realizing what financial planning is, because doing void cash flows and keeping you on track and being able to articulate your goals and work out when you need the money, how you need the money, what's the most tax efficient way to do it. Am I going to be okay? Do I have enough money? Am I doing the right things now that are going to mean when I finally decide to put my feet up, are me and my family going to be able to enjoy the lifestyle we deserve for the rest of our lives and not have to worry about anything? That is ridiculously valuable, but a lot of financial advisors don't do that. And unfortunately, they focus on the wrong things and the things they can't control, which is obviously invariably going to end up not going well, because you can't beat the markets, certainly not consistently, and they're focusing on the wrong thing. So yeah, that there's a parcel to it. But I think as our own clients will attest, once you've actually been through the process with us, you've seen it, you've got that value, the peace of mind knowing that if anything happens to you tomorrow, your wife and your kids, or your husband and your kids, or whatever, are going to be absolutely fine, is incredibly valuable, and not something you can do yourself. I have clients who have their own cash flow models, and no offense, but they're usually not very good. Sometimes they're missing very key things like inflation, or they're using delusional rates of return, and all this, or they haven't accounted for that, or tax. And this, or other considerations, and a lot of people are giving themselves a false sense of security, and aren't achieving the things and having the having the retirement they should have.
Yeah, very good. I think one of the points that stood out for me was your comment on the illusion of complexity, and I think that it also goes to your point of talking about how a lot of financial advisors are only talking about investments. So if you're only talking about investments and investment returns, if a client has a portfolio of 40 funds and 30 individual stocks, it kind of almost starts to plant this idea to clients like, oh, look at this, you could never have achieved this. Look at these 70 things that we've specializedly picked, hand-tailored for you. I think it's all from financial advisors almost trying to back themselves, like, look how difficult and complicated this is, when you've given the example that in comparison to Cameron James' portfolio of only 5 funds, but yet we're actually more diversified than, say, their 70 funds. So yeah, I think it's a really interesting point that you made there, and yeah, I think nice summary to bring that to a close there. I don't know if you had any other comments, John, or anything else you wanted to add to that.
No, I just think, there's that old saying, keep it simple, stupid. It's a bit like any engineers listening. When you've got a machine, once you build a machine, How do you improve the machine? Remove as many parts that can break as possible, keep it as simple, so if it needs fixing, it's very easy to do. And that's how you build a well-oiled machine. You know, adding different parts and layers and this, that, and the other is just more areas that can go wrong, and probably won't actually add any value, and if anything, will remove value.
Very nice. All right. Well, thank you for joining us today, John. Look forward to speaking with you soon. Take care. And listeners, as always, if you have any questions for myself or John, you can book in below via the Calendly link to have a free discovery meeting with us. John, thank you for joining today.
Yeah, more than welcome. And yeah, glad to add another face to the channel again.
Thanks very much. All right. And as always, take care with UK Pension Assets.